Well, if you're watching this or listening to us, presumably you're an investor, or if you're not right now, you want to be an investor. And you're usually looking for somebody who has the magic pill that's going to tell you exactly when to get in, when to get out, what to buy, and what to sell. Just something so you don't have to struggle. And there's plenty of advice which goes back years and years. And the problem that most investors have is they don't really want to take the time to do the homework, so they rely on the financial services industry. But the caution comes from decades ago in a book called Where Are the Customers' Yachts? Because they have them. Before we got started, we were just chatting about this. We're just going to kind of continue this conversation off the cuff. That book was really something that when I got into business was recommended reading, had to pay attention to it. The whole premise, and Perry, you talked about Warren Buffett. He basically rephrased this in another way, but the premise is Wall Street's interested in their welfare, even though they're selling you their interest in your welfare. It's a cover-up for the business reality.
Yeah, it's a sales pitch. It always has been. And that question, that book title, where are the customers' yachts? That's the crux of it. Wall Street has never had a problem producing wealth for themselves. Producing wealth for their clients is a different story. And in fact, sometimes it's not even on the radar. And as I said, Warren Buffett was talking about that book as being something to think about. Where are the clients' yachts? He added to that himself. He said Wall Street's the only place where people arrive in limousines to take advice from men who took the train to work. So that's how you know. That's how you know you're dealing with a salesperson who just got there and is just pitching the company line. Here's what we're selling. Here's why we're selling it. It's probably a great story. The Wall Street's great at producing great stories. And the gist of that book title is watch the outcome. Are you getting wealthy? Or are they getting wealthy? And that's the difference. That's what you have to watch out for. Who's the wealth being produced for? And if they're successful, does that trickle down to your portfolio? Or do they just have a great story, a lavish office, and they make you feel good all the time, but they're not actually producing any returns? It's important to notice the difference.
Well, you mentioned what's on the radar, and that often comes from headlines as far as the retail investor is concerned. What's the current story? And I think of two circumstances which illustrate that, one of which is recent history, and that's around the great financial collapse when the mortgage market went virtually belly up. And what had happened in that environment is we had readily accessible mortgages. You just had to fake an appraisal, basically, and you could get a mortgage for 100% of the property and wait for the next fool to buy it at a higher price. And that went on for a couple of years. Well, somebody had to buy those mortgages. Well, where do you get the money for that? Well, Wall Street says we'll get you the money. You need money to fund your mortgage pool. Hey, you just walk in here and we have a way to do that. So we will create diversified mortgage pools. We're going to take all these mortgages that we buy, break them into what are called tranches, different slices of the pie, and then we'll put different pieces together and call it diversified. When it turned out that everything was high risk, it was just 10 pieces of different high risk, which was not diversification, it was concentration. And there is a point at which Pied Piper has to be paid. And we got the market meltdown in 08 and 09. And there's a lot of pain left over from that. More recently is one which I actually wrote about this morning. And Perry, I know you've seen this in your email. As financial advisors, we're getting regular solicitations to diversify our clients' income portfolios into private credit debt.
Big time, lots of it. Yeah.
Well, and there's a company that operates out of a 4-bedroom house back in Pennsylvania. They got 20 employees, and they are doing they've done in over a number of years $1 trillion of rating credit on private debt. Guess where
Mm,
I think the next implosion is coming from?
right.
These are debt instruments that nobody's really checking out, and the difficulty of actually doing so is labor intensive. And that's not what's being done in the world of AI. It's saying, oh, that looks good. We check the number of boxes. That's all right. And they get a triple B rating. And nobody's getting a triple A. Maybe they get a double BA rating. But the problem is there's not real authentication, just the same problem in a different format that caused the great financial collapse of the mortgage business back in '08.
It's true. And we see that happen again and again and again on Wall Street because one of the things that investors are fascinated with is capturing a great financial mind. Okay, this is a brilliant concept that no one's thought of yet, and I can join. I can be a part of this. This is going to be new. It's going to be exciting. Look at this. It's a brand new idea. This private equity thing and private credit that's coming up right now. This is brand new. There's nothing brand new about it, but packaging it for the masses is brand new. But people are fascinated with, well, this is a great idea, and I'm not going to miss. It's that fear of missing out. So I'm going to get on board, and most of the time, it's just selling the next thing. And we're going to sell it, and it's going to be great until it's not. And when it's not, it's going to collapse, but that's okay because we're going to sell the solution to that too. And it's just the next thing. And as long as investors are willing to say, well, Wall Street's brilliant, and they're going to come up with the next great idea, and I'm just going to jump to that, they're going to just keep throwing out the tidbits and collecting the fees, which is what they're doing, collecting the commissions and saying, thank you very much. Wow, that one didn't work out very well, but look at this next one. It's going to be great. And people are just lining up to hand out their cash because they believe there's that great financial mind out there. Oh, this is something no one else has ever considered. And so this is going to be great. I'm going to be first in line. And I've got to move now or I'm not going to be able to cash in. So I've got to hurry. And anytime you get that feeling, I've got to hurry, that's a bad sign. That's probably something you should slow down and really take a look at what you're doing.
So where that shows up is when our greed button gets pushed and we have
Yeah.
an opportunity to get in on an IPO. Great
Oh, sure.
concept. The market's needed this for a long time. And here, if I just put enough of my money into this deal, if I commit it, I can get in, but I've got to dump a bunch of it in. One of the
Now.
things, yeah, and do it now. One of the
Yeah.
things that I was taught early in the business is if it's an IPO, sit back and wait. Give it 6 months before after it comes to the market to get the people who were in the beginning before it IPO'd to take their money off the table because they are
Correct.
in under such more favorable terms. The thing can collapse 10, 15, 20%, and they're still profitable. So typically within 6 months, all of that stuff pretty well washes out of the system. And now you need to evaluate whether or not there's actually hard reason, earnings, profit picture, product, real product
Absolutely.
that can work.
And
Um,
like everything else, the Wall Street will have been telling you, you don't have 6 months, you don't have 6 hours. This is going fast. You've got to get in here now. You've got to send us your cash today, or you're going to miss. And it's like, yeah, just take a step back and say, yeah, if it's that great a deal, there's no such thing as a miss. It won't. It's not going to matter which hour you got in on Thursday. It's going to be a matter of should you have gotten in on this at all or not. And you can't know that until there's a little more perspective. So unless you have personal knowledge of something inside an IPO, the best advice is give it a few months, not a few hours. You need some months in there to see what's going on. Let the capital adjust, and then you can get a better reading. But again, it's like, well, Wall Street's saying this is a can't miss idea. We've got to go with this today. It's like almost always a mistake. That's either fear of missing out or the greed of getting in soon. Both those things will sink your portfolio quickly.
so the issue is there an alternative? And the answer to the alternative to the stock market is mostly not. I mean, the stock market is an extremely
Yep.
resilient animal, if you will. people think there's a better way to do things. There have been scoundrels all of our lifetime.
Right.
I mean, only have to
Long.
read the Bible and you can find scoundrels of
There
plenty.
you go.
It's no secret. But whether we're what we've, I go back to where the customer's yachts, and pull a quote out of here. The only successful method so far devised for getting millions out of the public for enterprises both good and bad is some system similar to the devious mechanisms of Wall Street. Well, Wall Street can be a little bit devious because they have a different motive than you do as a retail investor. But what is the alternative? The alternative is an autocratic system that says you are going to do this, and they force you to do things that you wouldn't want to do, but it's your
Sure.
sole survival.
Sure.
And I was thinking of, in fact, I wrote about it this weekend, that part of the problem that China has today is that they kept COVID locked down for 3 years and really undermined their own economy and destroyed the confidence of their own consumers in the viability of the government. And it's really coming back to haunt them. My assumption is that President Xi and the powers that be who would kowtow to him
Right.
assumed that they were strong enough that they could cause the United States to buckle. What they did not and do not understand is the ingenuity of free markets. Yeah, there's a lot of things that we've developed in a free market system that have not worked.
Sure.
They've been disastrous. How about pet rocks?
They were great.
That one just comes to mind. I mean, so you paint some rocks and you've got you've got a product that you're selling. That's amazing. That's only one of many, but you've got other things that seemed like they were going to work, but real ingenuity. You think of creating the light bulb. It took 1,000 efforts before we actually got one that worked, and that one did work. And we have light today in order to do these today because of that persistence and the willingness to say that doesn't work. What's another way to do that? That's what the stock market flushes out when it raises money for a product or a new company. Correct. And if you're in on those and you're losing money, you have to understand that there's where you must be diversified, because when you're taking a running jump off a cliff at a new concept that's unproven, sometimes the landing is pretty hard.
Right.
And you have to have a long series of multiple efforts to come up with the home run that makes it all worthwhile.
Right. And there's no way in advance, unfortunately, of knowing which ones those are. I mean, just if you look around right now, if you just get online and do a search and take a look for electric flying cars, there's a lot of them. There's a lot of them out there. This is going to change the world. This is going to revolutionize transportation. Most of those are going broke. A high percentage of those are never going to make it. And predicting the winner is impossible at this point. But there's going to be a great story for this is it. This is the next big thing. You have to get a hold of this. This is the next cell phone. This is going to be unbelievable. Well, don't forget, most of the original cell phone manufacturers don't exist either. There's a huge shakeout in industries like that once they begin to take off, and most of them fall behind. And there's a few that survive. Picking those is virtually impossible. And so trying to be at the front end and dictating to the market who the winners and losers are going to be, that's a loser's game. You need to pay attention to what's going on. That's why we follow trends. We don't try to predict the winner. We find out where's the cash flow going to, and we go that way. And it's a significantly safer way to be on the good side of more investments.
Well, you mentioned cell phones. Most people think cell phones are a relatively new invention, but the original ones, the first one I saw was back in the 70s, and it was in a briefcase.
Right.
There was enough room to put in a writing pad and a pen, but the whole briefcase was taken up by the phone.
Right. and room for your ego. You had to have a giant ego to carry that around. So
That's right. But the laptops are something similar. I mean, the original laptop
sure,
companies, I think, for the most part, are gone. My original laptop, I think, was built by Toshiba, and it weighed 12 pounds. Can you?
right,
Today, we can't imagine carrying around 12 pounds of a laptop because it's in our hands. We call them cell phones today, but they have all the
right,
same capacity. But and prices have come down; they're more affordable. My first one, because I all my meetings were out of the office at the time. The first one was 12 pounds. It was $12,000.
right.
But given basically a traveling consultant financial advisor, I mean, my meetings are out of town. The thing paid for itself because I
Big
had
deal.
the
Sure, yep,
ability to do things outside the office that otherwise none of my competitors were doing.
to do it. Yeah,
But
true.
but that also became trash very quickly.
Yep,
I don't remember whether it was 1 or 2
excellent.
years later, but those things go away.
Yep,
And that's the same thing that happens with us when we're making mistakes about what we're doing in the investment business. We get committed to an idea and forget to look for the actual next phase. Investing is not a buy and hold for and ignore reality. It's buy what is going up as long as it continues to go up. When things quit working, there's something else you should be paying attention to. And you need a process for doing that. And we have a process for doing it. That's how we manage money. And if that sounds like something you'd like to have an individual one-on-one discussion with, give us a call, send us an email. We've got to chat with you. We can do an online call with you and walk you through our process and our charts. But thanks for being with us. Subscribe to our podcast. We have a lot more on our table we didn't even get to today. But have a great day. We'll see you on our next broadcast.